Hello everyone, welcome to today's lecture. I am excited to walk you through chapter 2 of the ACCA F3 Financial Accounting syllabus, which is all about the regulatory framework. So understanding this framework is essential because it sets the foundation for how financial statements should be prepared and presented, ensuring consistency and fairness across companies worldwide. So let's start by understanding what we mean by a regulatory framework. Essentially, it's a collection of rules, laws, and standards that govern how companies should prepare their financial statements. This framework is crucial because it ensures that financial reports are consistent, like companies follow the same guidelines, and financial reports should be transparent, clear, and honest reporting. And it should be comparable, like you can compare financial statements of different companies with these. For example, think of it like the rules of a game, right? If every player follows the same rules, the game is fair and everyone understands what's happening. Similarly, when companies follow these regulations, investors, creditors, and even employees know they are receiving accurate and comparable financial information. This in turn protects stakeholders from false or misleading information. Now, why is this regulatory framework so important? So the primary purpose is to provide guidelines for preparing financial reports. Without these rules, companies could make up their own accounting methods, which could lead to misleading or unfair financial statements. These rules ensure that financial reports are reliable and fair. For example, when a company reports its earnings, stakeholders want to be sure that the information is true and that it reflects the company's actual performance. If companies followed different methods, one could exaggerate their profits while another could hide losses. That's not fair, right? So, by following these guidelines, a trustworthy financial environment is created where investors, creditors, and even regulators can make informed decisions. Let's say you want to invest in a company. So, if the company's financial reports are trustworthy, you can make decision about whether to buy, hold, or sell that stock, right? To make sure these rules are being followed globally, we have regulatory bodies. The most important one to know is the IASB, or the International Accounting Standards Board. This organization is responsible for developing the IFRS International Financial Reporting Standards, which are the guidelines that companies around the world follow when preparing their financial statements. The IFRS Foundation. So, the IFRS Foundation oversees the IASB's activity. This foundation ensures that the IASB is doing its job of maintaining and updating these global standards as accounting practices evolve. On a national level, every country also has its own regulatory body that makes sure companies comply with these standards. For example, in Pakistan, the Securities and Exchange Commission of Pakistan (SECP) monitors compliance with the accounting standards, while in the UK, the Financial Reporting Council (FRC) does the same. Right. Now, accounting standards are the specific guidelines or rules that tell companies how to report their financial transactions. So, these standards cover everything, right? These standards cover everything from how to recognize revenue to how to value assets and liabilities. The International Financial Reporting Standards (IFRS) and International Accounting Standards (IAS) are the two main sets of rules used globally. For example, IFRS says how to handle things like leasing, revenue recognition, and even how to report the income tax effect. These standards ensure that when you look at a company's financial statement, you're seeing the same thing as you would for another company, no matter where it's based. Correct? For instance, if company A in Pakistan and company B in the US both report their financial performance using IFRS, you will be able to prepare their financial statements directly because they follow the same set of rules, right? This consistency is essential for global investors who need to assess the health of companies across the borders. So why do we need regulation? First and foremost, regulation ensures that companies provide transparent and reliable financial information. Let's say a company is reporting profits that seem too good to be true, right? Without regulatory oversight, there's nothing stop the company from falsifying these profits. With the regulatory framework, companies are held accountable for making sure their financial reports reflect the true state of their business. Secondly, regulation prevents fraud. We have all heard of companies that have inflated their earnings or misrepresented their financial health. For instance, the Enron scandal in the US. It was a case where the company manipulated its financial reports, leading to massive losses for investors and stakeholders. With the right regulation in place, such fraudulent activities can be caught earlier, protecting people from financial harm. Lastly, regulation allows for comparability. As I mentioned earlier, when companies across the globe follow the same set of standards, you can compare their financial statements and evaluate their performance on an equal footage. Principle based. Now let's talk about two approaches to accounting standards, and these are principles based and rules based system. So the IFRS is a principles based system, which means that instead of laying down strict rules for every situation, it focuses on the spirit of the law. Companies have some flexibility in how they apply these standards as long as the result aligns with the underlying principle. For example, IFRS allows companies to recognize revenue when they have substantially completed a contract. But how they define substantially completed may vary slightly depending on the situation. So this gives them some flexibility, but they must still follow the overall principle of recognizing revenue when it's earned. In contrast, a rule-based system is more rigid. The US generally uses a more rules-based approach where each situation has a specific set of rules to follow. This can sometimes result in more detailed guidance but can also lead to loopholes and manipulation if companies find ways to comply with the letter but not the spirit of the rules. So one of the cornerstones of financial reporting is the true and fair view concept. This means that financial statements must accurately represent the company's financial position and performance. So if a company is in financial trouble, its reports should show that. If it's doing well, its report should reflect that as well. This concept is crucial because it prevents companies from presenting misleading information, right? And imagine a situation where a company reports enormous profits to attract investors, even though its business is in decline. This would not only mislead investors but also harm the integrity of the financial system by adhering to the true and fair view principle. Companies ensure that they are giving a genuine and transparent picture of their financial situation. Now let's talk about the role of professional bodies like ACCA. These organizations are essential because they help ensure that accountants and auditors comply with the relevant accounting standards. They provide training and ethical guidelines to ensure that professionals adhere to the highest standards of behavior. For example, ACCA members are required to follow ethical guidelines that prevent them from manipulating financial reports. This ensures that accountants are not just number crunchers but also trusted advisor who play a critical role in maintaining the integrity of financial reporting. So, thank you so much for joining today's lecture on the regulatory framework. I hope you now have a clearer understanding of why these regulations are essential for fair, transparent, and reliable financial reporting. Make sure to review the material and practice questions to reinforce what we've learned today. So don't forget to like, share and subscribe my channel. I will see you in the next video.